Bank, Devang. But if you check on Yes Bank, horrible set of numbers. Axis Bank, just about okay. ICICI Bank, nothing great. Is the long trade or the long crowded trade in corporate banks getting challenged, Devang?
I think more so what we have seen is, yes, individually, if you look at all these numbers, there were different set of numbers from different banks, and Yes Bank faces a typically different type of problem, the kitchen sinking that was exercised after sort of the stock performed very well in the earlier couple of one quarter. I think it sort of is mirroring what Axis Bank or Yes Bank, ICICI Bank rather, did, I think 2, 3, 4 quarters back. But my sense here is that there are not many compelling trades in the market in the banking sector. Of course, HDFC Bank commands that premium as a sort of a retail bank. But I think clearly, if somebody still needs to buy on dips, some better candidates where ROE expansion is going to happen. So, for example, if Axis Bank, if we go by the management and they talk about 8% ROE getting into an 18% type of a league in another 3 years, and the type of cleanup that they have exercised, I think still there is a lot of scope for these banks to at least give you not more than, if not 25-30%, but 15-18-20% type of return CAGR for the next 2-3 years, particularly for Axis Bank. So my sense is, yes, the cream is out of the rally if you want to make that 40-50% which already has been made, but it's now a somber 15-18% type of boring returns which still can be made out of Axis or ICICI if you sort of time it or buy it in a couple of tranches.
Devang, wanted to get in your thoughts as well as to what's going on with, some of these pledge share scenarios, the likes of the SL Group. Now we know that Reliance Mutual Fund as well has sold in. A lot of nervousness in the markets on the back of this. Your take?
I think, yes, better to avoid the space where there is a lot of pledge share issue, and I think this has been continuing in the last 2-3 months. There has been bouts of volatility which these types of stocks have experienced. I think a lot of these companies have good businesses, have good business pipeline as well. The numbers also are good for a lot of these companies, but the overhang on these types of stocks have always been the promoter pledge or the debt on the books, which always is very difficult to manage during this types of market where there is one side polarization and second side your market breadth has also been very weak. So my sense is, yes, fundamentals take a backstage for this type of businesses during such a crisis. So yes, stay away from these types of businesses. If at all you buy a screaming buy or on a valuation side, place your bets in a way that you don't suffer in the shorter term, but over a longer period you make good returns. But yes, more so refrain from buying into companies where there are pledge shares.
Cement is clearly in focus. Devang, any opinion here? We're gathering that there's going to be a steep hike in cement prices, and this is incidentally the second one that we've seen in the last 2 months.
What we have started to do in the last couple of quarters is that start to look at or hunt for such types of businesses. Generally, we refrain from buying more of cyclical businesses. We are more into, I can say, high market share or market leading businesses in the place where there is pricing power. But yes, probably cement in the last couple of quarters have been showing a bit of traction. Last quarterly numbers of a lot of companies like Ultratech also see that the demand scenario is coming back, plus a bit of pricing power with price hikes also we have seen in a couple of pockets in India. So I think this augurs very well after a long time. Probably the demand for cement coming back. Maybe again monsoon would be subdued, but somebody having a 1.5 year type of a view, I think yes, cement presents a good opportunity. Cyclicals is one space where probably capital goods, select capital goods or select cement, you can start constructing a portfolio and post the election results. If a stable government is in place, I think the construction demand, infra demand, and a bit of housing demand could also come back, which can sort of cement can act as a proxy play for this type of sort of construction activity coming.
Everyone's telling me buy companies which have leadership, buy companies which have high return on equity, and buy market leaders. But if I qualify that as a filter and look at companies which qualify here, it's Page, it is Bosch, it is something like in Britannia. And look at the charts here. Page is down 30%. Jubilant Foodwork has taken it, is nowhere close to its 52-week high. Bosch has reversed completely and totally, even though they have a lion market share of of the category of the auto ancillary category in which they operate in. There you go, 6-month chart is down 12%. HUL Lion market share of the HPC category, that one also has reversed. Sundaram Fasteners not going anywhere. So do you think one should just get more realistic rather than following a predefined template of buying good companies and great businesses? One should acknowledge that these companies are nowhere available at levels at which they warrant a buy.
See, I think there is a clear distinction between, yes, as you rightly said, a great business, a good business, and also a third category, which I always say it's classified by Warren Buffett as a gruesome business. So you generally don't want to buy any gruesome business in the portfolio at any type of a valuation. Maybe it's a value or a value trap, we don't know. So gruesome, you have to stay away. Good businesses, yes, probably, as I talked about some cyclicals, you have to time it as and when you feel that this is the right price or the cycle is changing. Of course, it's very difficult to say, but cement capital goods probably qualifies some of these companies as good business. But great businesses are some of the businesses which you mentioned, like Britannia or maybe Dabur or HUL. These are types of businesses you don't want to sell, or either you want to buy in distress. So my sense is, yes, these are distressed times. I'm not saying that the price points right now probably after a 5% correction or a 10% correction will buy it. But yes, Page Industries from 35,000, if you tell me 35 to 32 or 30 or 28, yes, it was probably overvalued. A couple of bad numbers brought it to say 25,000 or 22,000 right now. So probably you need to time your bets that this is a time when you buy some consumption businesses like maybe Page Industries, or maybe even a contra call like Eicher Motors, which people will not find favor with right now at 20,000, but at 18,000 it would become sort of a screaming buy. So rather than venturing out into companies which you don't know, get into plain vanilla businesses where you know that the high market share and market leadership would come and help you in good times, and exactly don't sort of shatter you in bad times. So my sense is, yes, keep your bets ready, keep your list ready, and these are the businesses in India which you need to buy. There are 100-150 good businesses where probably you can sort of make money in a simpler way rather than venturing out of the 500 stocks that present itself.
I appreciate your time. Thank you for joining us.